$56.3 billion. That is what Meta Platforms reported in Q1 2026 revenue, up 33% year over year, a record. The same quarter, approximately 8,000 layoffs, roughly 10% of the workforce. If the money never ran out, why did the jobs? The logic was stated plainly. Chief Financial Officer Susan Lee confirmed that headcount was being reduced to fund AI infrastructure. The full-year capital expenditure target, $125 to $145 billion. In a single quarter, the company committed over $107 billion to cloud and AI, running at 4 to 5 times total employee compensation. Human positions and GPU clusters were competing for the same capital pool. Silicon won. The market flinched. After-hours trading sent the stock down roughly 7% despite record earnings. Record revenue, record income, and still 8,000 people received severance packages. The quarter left a question that financial strength alone could not answer. The May 2026 directive was not an isolated event. It was the logical successor to a doctrine forged in the preceding years, the year of efficiency. This earlier restructuring was a brutal but effective campaign, designed to strip away speculative costs and refocus the enterprise on its core advertising business. It was a system-wide reset, meant to correct for years of unrestrained expansion and prove that the company could still operate with discipline. The results were immediate and, on paper, profound. The strategy was an undeniable financial success. By the close of 2025, the company reported revenues of $201 billion. More critically, it generated staggering free cash flow, ending the year with a war chest of over $43 billion. This was the proof investors had demanded. It demonstrated that the organization could function as a lean, disciplined, and ruthlessly effective profit engine. The machine had been recalibrated, and it was working perfectly. Confidence was restored. The crisis appeared to be over. But this vast accumulation of capital was not destined for shareholder dividends or employee bonuses. The efficiency doctrine had refilled the company's coffers, but this new wealth was now designated for an entirely different purpose: to build a new kind of infrastructure, one that would consume capital at a rate that would dwarf everything that came before. The capital secured through the year of efficiency was not meant for a period of calm. It was ammunition for a new kind of war. Leadership announced an AI infrastructure initiative of almost unimaginable scale, raising its full-year capital expenditure guidance to a range between $125 billion and $145 billion. In a single quarter, the company made over $107 billion in cloud and infrastructure commitments, a figure that dwarfed the economies of small nations. This was a declaration of industrial intent. Massive proprietary data centers, custom-designed silicon, and new AI supercomputers would form the backbone of this new empire. But this strategy carried a hidden, monumental risk. Unlike competitors who built vast cloud networks and monetized them by selling services to thousands of other businesses, Meta's buildout was almost entirely for internal consumption. It was a concentrated, all-in wager that owning a superior private intelligence engine would create an unassailable competitive moat in advertising and user engagement. This was not simply an investment in technology. It was an attempt to fundamentally bend the market to its will. To fund a vision of this magnitude, however, the company would have to find the capital. The decision was made that the most direct source was its own balance sheet, starting with its human-led divisions. At some point, the internal calculation stopped being implicit. Chief Financial Officer Susan Lee confirmed it without softening. The company was trimming headcount to fund its AI investment. Human positions and silicon infrastructure were competing for the same finite pool of capital. Silicon won. It wasn't even close. Then Mark Zuckerberg said the quiet part out loud. AI would enable one or two people to accomplish what previously demanded dozens. Not someday, not theoretically. This was organizational architecture, stated as policy from the corner office. Human labor in this framework was no longer a resource to be cultivated. It was a variable cost, a line item weighed against the price of a GPU cluster and a megawatt of electricity. The arithmetic was merciless. Meta's AI infrastructure spending was running at 4 to 5 times its total employee compensation. Read that ratio again. When a company spends $4 on machines for every $1 on the people who built it, headcount stops being the primary resource. It becomes the primary expense. By Q1 2026, the workforce had already contracted to approximately 77,900 employees, down 1% from the prior period, a quiet bleed before the hemorrhage. The 8,000 positions scheduled for elimination in May would accelerate that contraction with clinical precision, and there was no ambiguity about which side of the ledger leadership had chosen. Severance packages offered 16 weeks of base pay plus 2 additional weeks per year of service, alongside 18 months of health coverage. Generous enough to look humane in a press release, precise enough to have been modeled on a spreadsheet months in advance. For thousands of employees, the trade was a pink slip. But for the market, the consequences were far more complex. Because the same quarter that produced these cuts also produced record revenue of $56.3 billion. The company had never been healthier. The people inside it had never been more disposable. The market's verdict was swift and unambiguous. Despite record earnings, Meta's stock fell approximately 7% in after-hours trading. This was not a punishment for poor performance, but a vote of no confidence in the strategic trade itself. Investors were not questioning the $56.3 billion in quarterly revenue. They were questioning the wisdom of using it to fund a $145 billion capital expenditure plan with an uncertain long-term payoff. The cost of shedding 8,000 jobs was meant to signal fiscal discipline. Instead, the market interpreted it as a desperate, high-risk wager. The anxiety was validated by a troubling signal from deep within the company's own data. For the first time since the metric was tracked, the number of daily active people showed a sequential decline, settling at 3.56 billion. The very foundation of the empire, user growth, was showing its first crack. At the precise moment leadership was liquidating human capital to fund its future, the core product was exhibiting signs of weakness. The internal fallout was just as corrosive. Reports emerged of collapsing morale and widespread employee skepticism, creating profound execution risk for the very AI projects the layoffs were intended to accelerate. This was the paradox: a company sacrificing its people to build a new machine, only to find the people who remained were losing faith in the blueprint. The market saw the risk, but what it was truly pricing was a fundamental flaw in the strategy itself. What happened at Meta is not unique. It's a syndrome, spreading through Silicon Valley like a slow-moving contagion, and it needs a name. Call it the capex-first blind spot, the doctrine of prioritizing capital-intensive infrastructure, like $145 billion in AI buildout, over the human capital required to make it profitable, particularly when no clear, near-term monetization exists. The flaw compounds immediately into what we can call a payback mismatch. Amazon, Microsoft, Alphabet, they fund massive infrastructure by selling cloud capacity to external customers. Revenue flows back while the machines are still warm. Meta's bet is entirely internal. No outside revenue stream, no hedge. Just a long horizon payoff colliding head-on with investors demanding nearer-term returns. Then comes the second fracture, the morale execution paradox. You cannot systematically eliminate thousands of workers to fund innovation and then expect the survivors to execute a complex, multi-year vision with full commitment. You're asking people to build the thing that replaced their colleagues. The talent you need most becomes the talent most likely to leave. The core lesson is about capital allocation. Meta treated its workforce as a funding mechanism for machines, trading a predictable, productive asset for a speculative one. That initial 7% after-hours stock drop was not merely a reaction to spending levels. It was the market assigning a price to that exact gamble. Meta bet that the future belongs to machines, not people. The question now sitting in every boardroom across the industry is simple and unanswered. What happens when that bet is wrong?